We're also live on YouTube and on Zoom. A few more minutes, we'll go ahead and get started. If you guys have questions as you wait or you just want to say hello, go ahead and chat those questions in. If you guys are on Facebook, you can use the live chat. YouTube, you guys can use the live chat. And of course, here on Zoom, you guys can use the chat function as well. Hey, Ravi, how are you? Nice of you to join us. Just a few more minutes, we'll get started. All right, everyone. Welcome to Day Trade Smart's Masterclass. We're going to go over well, I've got the disclosures up. I've had them up for a little while. If you guys like to pause the video from this point, feel free. As we go through this session, of course, you can feel free to ask questions. We want to make sure that you guys are able to engage, so feel free to chat. If you guys are on Zoom and you'd like to participate, we'll even have you unmute your mic at some point as well. For those of you guys that are on Facebook and YouTube, feel free to chat in any questions at some point during the session. We'll make sure to get to those questions, of course, here on Zoom as well. If you guys have questions, feel free to chat that in. All right, so thanks for joining us. Here are just some of our social media links if you guys want to follow us on social media. I'm not going to spend too much time on that. Again, you guys can pause and collect that information if you'd like. So I want to start off with something really simple. I want to ask you why you're here, right? And for those of you guys that have attended this particular Thursday masterclass, you're going to see that there's it's virtually carbon copy, right? We're going to do them every Thursday, but it's not necessarily progressive. We're going to have the same information every Thursday. So if this is your second Thursday, just be aware that if there was something you missed the first time, great, welcome. You're always welcome. But it's not going to be any new information from last week. So in terms of why you're here, I really want you guys to explore that. Why you're interested in day trading, what is it that draws you to the financial markets, in general? For some people, you're just curious. And I'll tell you right now, if it's something that you're just curious about, by all means, hang out. Perhaps after this session, you'll be more engaged in what day trading has to offer. But I'll be honest, for our programs, if it's just curiosity, it's not going to be a good fit. right? It's something that for our people, we want them to be engaged, we want them to be connected, and motivated. And so, if it's more just curiosity or as a hobby, it's just not really a good fit, right? And we'll get into that later on. We'll get into how you can day trade our corporate funds and the like. For others, it's to supplement income, right? Get to a point where you're making, 30% or more of your current income. Obviously, for different people, it's different, right? Just depending on what you currently make, a supplement or even replacement of income looks different for everyone, right? Maybe it is to fully replace your income, or retirement. Maybe you just want to stack your retirement, or you want to retire early, right? Lifestyle. A lot of people want that higher lifestyle, right? A better house, nicer car, more vacations, whatever the case may be. The biggest one that we hear, once we drill down, we have an opportunity to drill down, is time freedom. All right, time freedom, being able to not to have a way to earn without being tied to a 9 to 5, right? Without having to ask permission to travel or to leave, or whether or not you're going to work that day. So, time freedom is huge, and what we're proposing is that very thing, right? You can do in the time that it would take you, let's just say, for example, a 9 to 5 job, which, for those of us that are in today's economy, that's not a thing. It's more like a, 7 to 7 job, right? You're working 12 hours. You're trying to get as much overtime as possible, because things are expensive, right? We've got a lot of stuff going on, especially right now, where, your standard 9 to 5 just may not cut it, right? Depending on what you make hourly. So, having the ability to not have to answer to anyone, maybe take an hour or two a day, if not less, place some trades, make what you would make in your regular job, and go about living your life. We have people that they love what they do, and they continue to do that thing. But most people we encounter want to walk away from what it is that they're doing and get into something else that isn't so time consuming, so that they can earn it and then enjoy it before they're 70 years old and, perhaps on their deathbed, right? So you not only want to earn it, you want to be able to enjoy it, obviously. So what have you tried in the past? Ask yourself, what have you tried in the past to try to accomplish some of these things, right? Your why, whatever your reason is. It's not just to make money, right? It's what you want to do with that money. It's what that money will bring you, right? Time freedom, lifestyle, retirement, replace your supplement income, those types of things, right? What the money is going to give you, not just to earn the money, right? So what have you tried? A lot of people have tried a lot of things. There's a lot of things out there. Side jobs, right? You've got your main job, and then you've got your side jobs. You've got a lot of Uber drivers, Lyft drivers, things like that, right? Where you're just kind of working a part-time gig on top of whatever your primary gig is, to try to earn enough money as possible, so that you can at some point get to that why, that reason why you're looking at day trading. This is perhaps not the only thing that you looked at when considering how to get to those goals, those financial goals, right? And there may have been things you've already tried, right? Maybe work overtime. Maybe you've gone to college, you're considering going to college. Other business ventures, MLMs, right? Attempted trading. That's another one that we run into, right? People have attempted it, right? 90+% of individuals that attempt to day trade fail. 90+%. You guys can look that up. I don't expect for you to take anything I say, without checking it, right? I don't expect you to just believe me. But definitely look into all the things that we're going to talk about today. I'm going to give you guys some math and science behind why we do what we do and how we do it so successfully. And you're going to be able to vet that. You're going to be able to see that that's not just our opinion, right? But 90+% of individuals that attempt to day trade fail. So what does that tell you? That tells you that a lot of what's out there is not viable information. I mean, it's just the facts, right? A lot of if it was just as simple as going to YouTube, and watching a whole bunch of videos and learning how to trade and being successful at it, then, that statistic wouldn't be that way. It wouldn't be like going to Vegas and trying to hit a jackpot, right? We've got it down to a math and science, so it's not gambling. right? Our traders are hitting 70, 80, 90+% win percentages with risk to reward ratios that are profitable, right? And we've got thousands of traders trading our corporate funds. And we'll get to how you guys can qualify to trade our corporate funds as well. We're going to do that towards the end of the session, so keep an eye out for that. So consider that. What things have you tried? And if you guys want to even chat some of that in, things that you've tried or why you're here, right, go ahead and chat that in, right? The more you engage in this, the more you're going to get out of it. So, you know, whatever that might have been, why you're here, what have you tried in order to accomplish that why? And did it work out? Right? Yes? No? Still trying? Right? What things have you tried or are currently trying? You know, maybe you've tried nothing, right? And you're still trying nothing. And obviously nothing's not working out for you. Or maybe it is. I don't know. If it is, usually you wouldn't be here, right? You wouldn't be talking to us. You wouldn't be watching this webinar. You wouldn't be looking into things like this if what you were doing was working. Right, so I really want you guys to consider those things. And as we go through this process, I want you guys to be able to evaluate the following. Can you do it? All right, is this something you're capable of doing? Will you enjoy day trading? All right, so you don't want to get into something and commit time, effort, energy, you know, all these different things to, and you hate it. Right? Just think about it. How many people you know, or maybe you're one of those people, you went to college for a certain thing and you got into the workforce, or maybe as you were going through college and going through the courses, you realized that you would be miserable doing whatever that career was. You would just be absolutely miserable, right? So, you know, you don't want to run into a situation where, you know, you get too invested in something and you realize you hate it. Because if you're not going to be dedicated to it, it's just not going to work out very well for you. And so we want you to be able to evaluate, can you do it? Is it something you're capable of? And will you enjoy doing it? Will you enjoy day trading? Is it valuable? Is it more or less than you expected? I want you guys to be able to evaluate these things, right? And does it meet a personal need? Will it meet or exceed your why? The things that, you know, the things that drew you to day trading, the things that drew you to this particular webinar, you know, and the things that drew you to trying out the things that you had tried in the past. Right? I want you to consider those things. And will it meet or exceed those needs? Will day trading meet or exceed those needs? Right? Those are the things I want you to be able to evaluate through this process. And for us, when we accept somebody into our program, all we really look for are people that are good students and show up to appointments, right? It's like any other education. Our trading university is like any other university. You can go to a class and not be teachable. You can show up all the time, have 100% attendance, and not be teachable, and you'll learn nothing. Or you can be the most teachable person in the world and never show up, and again, you won't learn anything, right? So you got to be both. All we're looking for is dependable people that will show up and be teachable. And we'll talk about how we can vet each other later on with one of our programs. All right, so let's go ahead and get into this, guys. We're not going to delay, waste any time with unnecessary fluff. We're going to get right into it. So here are our core indicators. Now, this algorithm is proprietary to our organization. These indicators might look like things that you've seen in the past, but I can guarantee you this algorithm is like nothing you've ever seen before, and I'll show you some of that today. All right. So our core indicators are the T and T's, and we're going to show you these here in a moment. So these are the thick orange, thin orange, thick blue, and blue dotted lines that you'll see on the charts that we pull up here in a moment. Now, at their base functionality, the orange lines are directional, meaning when they point up, they're indicating up in certain situations, and we'll get to some of that. And the blue lines are inverse. So when the blue lines point down, then at their base level, they're actually indicating up. And the reason why we have them inverse is because if we pointed them all in the same direction, then they would overlay each other and you wouldn't be able to see some of the nuances. So we had to inverse, two of them. So the blues are inverse, the oranges are directional. And we'll get to some of that later on. Major and minor. So the green and red lines here that we can see right here are the major impact, and the gray and black lines are minor impact. I'm going to close that Epic Pen and reopen it because it's not working. Okay. So the green and red lines are major impact. The gray and black lines are minor impact. And then this thick red line right here represents the overbought, or rather oversold portion of the market. This is a zero-sum game when we talk about day trading. And then the thick blue line is the overbought portion of the market. And those will come into play later on. And then here we have the pressure indicator. Now, our pressure indicator is the fastest predictive indicator in the industry. And we have multiple examples of that. And we can not only show that to you, but we can also have you try out our indicators so that you can see for yourself that they work as effectively as we claim, right? So we're going to look at a trade setup right now. We're going to get right into this, look at a trade setup. I'm going to teach you guys one. So I would say within the first 10 minutes of this session, you're going to know this trade setup. So it's really that simple. And it's just one. We've got many, obviously. But before we do that, I kind of want to explain to you how the indicators work. So there's three types of indication. The first is logical. The indicators work logically. The direction they point is the indicated direction. Obviously, with the exception of the blue lines, because the blue lines are inverse. So they, at their base level, at their logical level, when they point down, they're indicating up, which in and of itself is illogical. But if you understand that that's what their base functionality is, then that would be logical for you. Now, there's also illogical. Illogical is the direction they point is the opposite of the indicated direction. So that means that sometimes, just based on small nuances, the indicators can point up and actually be indicating down, or down and be indicating up. Now, there's a whole, a process to understanding these nuances. So the way we teach a lot of these nuances is by introducing a pattern-based, more systematic setup, right? So it's square peg, square hole parameters, right? Very specific parameters, and when those parameters are present, then that gives you the go-ahead to execute on a trade, either for buy or sell. And I'm going to clean up that buy-sell thing later on as well, so that we're on the same page when we talk about taking profit and how we do that. So learning to fluently read the indicators takes practice and discipline to back testing. And back testing may be something we'll talk about a little bit later on. But it's not like, you can go right now onto, any of the social media sites or anywhere where you can find, information on day trading. And, it always baffles me that no one talks about back testing correctly. This is like it's like blueprinting, right? Before you build a house. You would, a contractor wouldn't even dream of building, even if they've built that house multiple times, they wouldn't even dream of building that house, if they didn't first have a blueprint to go off of, right? And so it's the same way with day trading. Back testing is how we create that blueprint, right? We go back for a specific period of time on the currency pair that we trade, for the specific times that we trade, for the specific setup that we trade, and we check to see how it performs. We collect a certain subset of information, which we call here at Day Trade Smart, we call that, we've coined it the golden ratio analysis. Obviously, we kind of ripped off the name, but we call it the golden ratio analysis, and essentially what it does is it tells us what the most optimal stop loss and take profit are within a win percentage that's profitable for any setup, anything, anywhere, anytime. So the better the indications you're getting, like for example with our proprietary indicators, the higher win percentage, the smaller risk rewards you'll have, which makes it more profitable. And especially if it's something that happens very frequently, which is one of the first setups that we're going to go over here in a moment, is it happens a ton of times, and I'll show you guys, because it's one that we track. I'll kind of show you how you can receive alerts for that particular setup as well. So most traders, at least initially, are more comfortable with the third option, pattern-based. It's like sight words when first learning to read, right? So when when our kids go to school, maybe the teacher shows them, a word. Let's just say they, THEY, right? And at that point, the kids may not understand how to sound out they, but they see the word, and the teacher tells them what the word is, right? And eventually they just understand the shape of it, and when they see that word, they understand that word is they. And if they learn enough of those sight words, then they could open up a really simple children's book and be able to be successful at reading. In that same way, we can teach you pattern-type setups that you can use to leverage in the market and be profitable, right? And now there are some traders that want to take it a step further and learn how the indicators work at all their levels, right? So logical, illogical, pattern-based. They want to really expound on their knowledge and understanding. And really, what that takes is experience and backtesting and going back and looking at these things and kind of connecting some of the dots that we put before you. And others just want to be able to just take the pattern trades, right? And there's not one that's better than the other, right? So some never deviate from that systematic, and others, will devote themselves to reading the indicators discretionarily, and some will use a more hybrid approach, right, where you've got a systematic setup, so maybe a starting point, all of these parameters are present, and so here is where I'm going to start looking at the market, but I'm going to use some discretion based on my experience to determine if that's the best place to enter, if I should wait, not take the trade, position, whatever it might be. Now, there's no universal right or wrong approach. Ultimately, it's what's right for you, okay? And this is important because day trading has to be specific to you, right? There's no cookie-cutter approach. And although people try to create these cookie-cutter approaches, they don't work. Where is the proof? 90+% of individuals that attempt to day trade fail, right? Our students are doing way better than that, leaps and bounds beyond that, right? So we know that that type of stuff is not very effective, right? Just trying to have a cookie-cutter approach. Now, I'm not talking about in terms of a pattern, but you could take that pattern and make it specific and unique to you, your risk appetite, your personality, right? You go back for the specific times that you trade, right? You go back on a specific currency pair for a certain amount of years, and you test that setup, right? If that's what resonates for you, whatever setup you feel resonates for you, and you collect that information, and then from that you're able to extrapolate the best approach, the most profitable approach for that trade that fits you for the times that you're available to trade and your risk appetite, right? So when we talk about risk appetite, there's a couple ways we can look at that, but with regard to what we're talking about right now, once you get into a demo account, if you guys have never demo traded or anything like that, I would highly recommend doing that immediately. Go and download a demo software for whatever market. Now, I want to be specific today. We're going to talk about Forex. Now, our indicators and our program works on obviously just about any market, but for the sake of ease, we're going to talk about Forex. So I do want to let you guys know that, and I'll kind of explain to you some of the lingo for those of you guys that are not familiar with some of the lingo as we go along. Now, so whatever approach you decide to take is going to be unique to you as an individual, right? So for some people, once they get into a demo account, they realize that when the markets are moving really fast, that makes them anxious, and anxiety causes for you to have these psychological effects on your trading, and for you perhaps not to have success at trading. And others have the same symptom, but for the opposite reason. Maybe the market moves too slow, and they're in trades too long, and that causes for anxiety for them, right? So it's the same symptoms, right, but different conditions. So what is right for you may not be right for someone else, right? So it has to be very specific to you and your situation, right? So the times that you're available to trade, and then the currency pair that you trade at that time can reflect that risk appetite, because each currency pair, for example, moves differently at different times of the day. Some move fast in the morning, others in the evening. And so if you like the fast-moving markets, then we'd put you with, depending on what time you're available to trade, we'd put you in one, we would want to pair you with one of those particular currency pairs. And with regard to the best times to trade, which is kind of what we're talking about, the best time is when you're available. So you're not, getting ready for work in the mornings, or sleeping, or commuting to work, or working, or having dinner, or, wrangling kids, whatever it might be. Maybe it's like 9 p.m. at night, when the kids are settled, the spouse, you and the spouse have had some time, maybe you've already had dinner, whatever, right? And now you're about to sit down and watch Netflix. But now, instead, you're going to day trade. Right? That's the time for you, because that's what's right for you. It's not going to be the same for everyone. Right? It might be different for someone in Australia. It might be different for someone that works in the service industry as a bartender, or a hostess, or a host, or a waiter or waitress. Right? So it's different for everyone. Right? So you got to consider what's right for you, and then you form fit day trading to you and not you to it. If you try to form fit yourself to day trading, right, then you always end up kind of feeling like a fish out of water. Somebody's unmuted, which is okay. Thank you. Which I don't necessarily mind, but as long as you're asking a question. But it sounds like you were just unmuted. All right. Thank you for muting. Okay. So let's look at some examples of some trade setups here. All right. The first one we're going to look at is called dirty pressure. All right, and we name them just so that, they're easily referenced, especially as we're in a group. We have means of communicating with one another within our organization by way of, chats and, different forms and stuff that are real time, that are live. And so it's a lot simpler to just kind of, name the pattern versus try to explain it, right? So for this dirty pressure setup, we're only going to be using the pressure indicator, which is down here, and we'll pull up the charts here in a moment, and then the major minor indicators, which are here. For this setup, we won't be using the TNTs. Okay, so what we're going to look for is just when this green line intersects. You can see it's intersected right there with the red line. Now, when it crosses on top of the red line, so right there you can see it's on top, then at that moment we want to see all four of these lines pointed up. And then at the end of this candle, if all those parameters are there, we would take a long trade or a buy trade. Now in reverse, if that green candle crossed on bottom of red, we'd want all four of these lines to be pointed down. And if they were pointed down when the candle ends and the green was on bottom, then we would take a short or sell trade. And I'll explain to you guys, for those of you guys that aren't familiar with that concept, here in a moment. Okay. So let's go ahead and go to our charts. And of course, I'm going to explain it again, show you guys some examples. All right. So let's use this chart and go back. And, whoa, went a little too far. Okay. So right here, we can see that the green line is on top of the red line. Okay. So the first thing we're waiting for, we want to occur with this indicator first. Okay, so this is the pressure indicator. Now, notice that sometimes these lines get really close together, like right there. Get really close together, and so it's hard to see which one's on top or bottom. So I've got this other chart right here. So that is the exact same thing as that. It's just stretched out. Okay, so and that's just for the session today. Just for the sake of our exercise today. Okay. Normally, if we wanted to see that spread out a little more, then we would just kind of stretch that out and then put it back. Because if we left it stretched out, obviously you can't really see very clearly what the other indicators are doing. So we don't like to look at it stretched out that way. But if we had to just momentarily, then we could stretch it, see which one's on top or bottom, and then kind of put it back to wherever it was. Okay. So right now, the green line is on top of the red line. It's on top. And just for semantic purposes, we'll just refer to green where green is. So if we say green on top, when we think top, automatically our brains think up, right? Like top shelf. So when green is on top, then we want all 4 of these lines pointed up. Okay, this is the best, just semantically to be able to memorize these parameters. And then when green is on bottom in pressure, green's on bottom, we want all 4 of these lines to point down. So again, when we think bottom, we think down, like bottom shelf, right? We think down. So it's just a good way to remember green on bottom, which way do I want them pointed? Down. If green is on top, which way do I want them pointed? Up. Okay? All right. So let's go ahead and go forward and look for our first example. So right now, green's on bottom. And right there, green has just arrived on top in pressure. How do we know? Because on the previous candle, green was on bottom, right? We can see it right there. A little more clearly, we can see right there. And then on the next candle, green is now on top. It just intersected with red, and green is now on top in pressure. And when green is on top, we want all 4 of these lines pointed up. Now, these are the same examples I showed last week, but what's interesting about this particular setup is later I'm going to show you how all of this actually gives you an indication to sell, which is really cool, and I'll show that to you. But right now we're not looking at that. We're going to look at this setup, which the parameters are green on top, all 4 lines pointed up. So right there, when this candle ends, we would take a buy or a long trade, okay? And what we're looking at here is the Euro USD 60-minute chart. So this is the Forex market. Now, if you guys are not familiar with how candlesticks work, I'll give you just a quick rundown of how candlesticks work. So a green candle starts here, right, and then moves up and finishes higher than where it started. And that's a green candle. Okay. A red candle, let's say if the next candle was red, then it would start here and it would finish lower than where it started, and that's why it's red. Now you'll notice that on some of these you have these little thin sticks on top and bottom of these candlesticks. They kind of look like this, right? Those are called wicks. So a wick is always on top and a shadow is always on bottom. Okay, so a wick and a shadow. Okay, so a green candle, this is its open, that's where it opens, and then that's where it closes, right there. The body of the candle, right? That's the open, and that's the close. The wick is how high it went in that time frame. So if we're looking at a 60-minute chart, in that 60 minutes it went up to this high, and then it went down that low, but it didn't stay there, right? It maybe came down that low at some point and then went up to here at some point and then came down and then ended right there. So this is the open where it started. This is where it ended. That's how high it went in that hour, and that's how low it went in that hour. Red candle opens here, closes at the bottom of the body, and these are the same. That's the low, and that's the high, how high it went, okay? All right, so for those of you guys that aren't familiar with how candlesticks work, that's a quick synopsis. Okay, so right here we've got our green candle, and that means, again, it ends at the top right there of the body. And all the parameters were there when it ended. So right here we would take a long or a buy trade. Now our entry is 1.20720. Okay? This means that it costs $1.20,720 USD to purchase a euro. So the first listed EUR is kind of the king currency, and the USD is secondary to that. Okay? So it costs $1.20 US dollars to purchase 1 euro. So a euro is worth more than $1 at this point in the market, right? And it's been that way since early 90s. It's always been worth more, not this specific price, but worth more. The euro has been worth more than the US dollar. Okay, so this number right here at the end is what we call a micro pip, or a point, okay? This number right here is the pip, and this is the number that we trade on, the pip, okay? PIP. So for this particular exercise, we're just going to use 10 pip stop loss and a 5 pip take profit. Now, I want to be clear, there's no real math or science to justify why we're using these parameters. I'll explain what stop loss and take profit mean here in a moment. Okay, but for those of you guys that know, there's no justifiable reason. This is just to practice with. In order for you or I or anyone to determine what stop loss and take profit you're supposed to use in the market, you would have to backtest and find out. Okay, but we're not going to go into too much detail on that right now, but I do want to be clear about this. If you were trading with this setup live, maybe you would use those parameters if that's how your backtesting showed out, but it's not likely, right? Because this is just something that we use to give to our members when they're first, learning, just as a target, right? Something to practice with so that when they're setting a stop loss and take profit, they have numbers to put in there. So let me explain to you what a stop loss and take profit are, okay? Now, we're going to focus on just these three middle numbers right here, which is 072, okay? Now, this is called a risk, okay, risk to reward. And because it's called a risk to reward, then the first number that's listed is the risk, and the second number is the reward. Now, this is what's referred to as a 2-to-1 risk to reward ratio, because in this particular example, we're risking 2 times the amount that we're looking for a reward. You would say, well, that wouldn't make sense if anybody used that. Well, it would if you won this trade 70% of the time or better, okay? So in order for a 2-to-1 risk to reward to be profitable, you would have to win that trade 70% of the time or better. And you don't want to guess as to whether or not it's going to work 70% of the time or better. You want to backtest to make sure it's going to work that way, okay? And there's a whole formula for backtesting. All right, so that means that if I'm going to take a 5 pip profit, then I want this second number right here, this 2, I want that to move up by 5 pips. So if I'm going to figure out what my take profit is, then I'm going to add 5 to that 2, and that's going to become a 7, right? Because 2 plus 5 is 7. Then I'm just going to carry up that 0, and that 7, and that 0 right there, and that 2, and that right there. So now my take profit that I can set will be 1.20770, okay? 1.20770. Right there, I'm going to make that line blue. And then our stop loss, okay? So this tells our MetaTrader 4, right, let me kind of show you what MetaTrader 4 is here if you're trading Forex. Let me bring this up. Okay. So this is MetaTrader 4. This is how we would place buy and sell trades in the market. I would definitely recommend you guys downloading MetaTrader 4 with whatever broker you'd like. We don't recommend brokers. We're not an introducing broker. But so choose whatever one you'd like. On our YouTube channel, we have videos for beginners, and if you go through some of those videos, we'll teach you some of the things to look at, to try to find in a broker, but we won't recommend brokers. Okay. All right. So right here, we would press the sell or buy button if we were getting into the market, and so when we do that, when we press the sell or buy button, let's say in this case we press the buy button at that line, then we need to tell that system where we want it to take us out and award us profit and give us profit, right? So in this case we told it at 1.20770, if the market gets to that point, get me out of the trade and give me the profit. Okay? Now, if it does not do that, then you got to tell the system, you got to tell that MetaTrader 4 system where you want to be taken out to stop the bleeding, right? So you don't continue to just lose money, right? And that's called a stop loss. So here we're going to use a 10 pip stop loss. So again, we're going to look at these numbers. Now it's easier, that's why we're going to look at these three numbers, because it's easier to look at these three numbers, you know, if they're nines, or in this case, because we're subtracting 10. But right here, the number is 72, right? That's our entry. 72 minus 10. So really simple. What's 72 minus 10? 62, right? So 62, and then bring down that 0, bring down that 0, 1.2. So we've got 1.20620, right? So that's our stop loss, 1.20620. Okay? Make that line red. All right. So now we've got, you know, if we did it using MetaTrader 4, it would look like this. So let's say we were going to take a buy. So we would just press the buy button. Let me just put that there. Press the buy button. Okay, that's a buy. Now this is in a demo account, and this is, we're not allowed to take live trades with prospects, only people that are part of our membership. So I'm not taking this for the sake of making profit. I'm taking this trade in a demo account for the sake of showing you how MetaTrader 4 works. So right here is my entry, and if I drag this line right here up, then over here on the right, I can see that it says 88, which means 8.8. If it's blocked by that, then there's another way to do it where you can just right-click, modify or delete order, and then I would tell it right here. If my entry is 91754 and I'm going for 5 pips, then I'm going to go to 91804. So 91804. That would be my take profit. So that's telling the system, when you get to that line, take me out and give me that profit. Okay? But then I can also tell it, I don't want to go more than 10 pips negative. So if I drag this line down, I can't see it. Let me go here, modify. So my entry is 91754. So I don't want to go to 91654. So 91654. Boom, right there. So I don't want to go to this line before I go up to this line because I'm buying. Okay, I want the market to go up. Okay, now I'm just drawing lines here to kind of show you guys what that looks like. All right, so on the next candles, I want to go up to that blue line before I go down to the red line. So let's go ahead and click forward. Okay, so that moved both directions. That went up 9.3 pips and down 10.7 pips. Okay, so we went both directions. We have to see which one went first. So let's go back right here. Now this is a 5-minute candle. All right, that means that each of these candles are 5 minutes in the market, right? What the market did in 5-minute increments. Okay, so that means that there are 12 of these candles in one of these candles, because this is a 60-minute chart. So these 12 candles make up one of these candles, okay? So if I wanted to see what happens in the first 5 minutes of the next candle, I could use this, right, if I'm looking back historically like we're doing today. So you can see that they're linked. If I move one, they all move. So you can see that the price is the same right here, 1.20720, 1.20720. Okay, so let's move one candle over to the right on this 5-minute chart. And the first 5 minutes, the market went up 6 pips and down 4.5 pips. So yeah, we would have won, right? Because it would have gone up more than 5 pips, which is our take profit, and not gone down 10 pips. So would we have taken profit? Yes, because it would have gone up first and then down. So even though overall It did both. It went up to that line and down to that line. It doesn't matter because it went up to that line first. We would have been taken out in profit. That profit would have gone into our brokerage account. We would have been taken out of the trade and not at risk in the market anymore. So it doesn't matter if the market would have shot way down. Once you're out, you're good, right? You're out of the market and you've banked that profit. And we'll get into what some of these profits would be worth in theory here in just a moment. Okay, so let's go back to our trade setup. All right, so quick refresher. Green is on top, and now we're waiting for it to cross on bottom of red. Okay, so right there, green crosses on bottom of red. It's hard to see right there. You can see it right there really clearly. Okay, so now green's on bottom. And again, when green's on bottom, when we think bottom, we think down. So we want these lines to be pointed down. And in fact, they are pointed down. We want these lines to already be pointing down when that intersection occurs. So in other words, if green popped on bottom and these lines were not already pointed down, and then on the next candle they started to point down, that would not count. We want them to already be pointing down on the same candle that green intersected with red, okay? Or pointed up if green intersects on top of red. Okay, so right there we would enter our sell trade. Now a sell trade is, for those of you guys that aren't familiar with how day trading works, the great part about day trading, and if you didn't know this, you're going to be really excited to hear this. One of the great things about day trading is that whether you're buying, wanting the market to go up, and if the market's going up, or if it's going down, you can make profit. Okay, so it's not like a stock, right? How does a stock work? You buy a stock right here, and let's say it's $1 a share. And then you wait for it to increase in value. Let's say it increases in value to $100 a share, right? Depending on how much you had in there, you did really well, right? Okay. So, imagine you bought, $10,000 at $1 a share, and now it's 100 times that, right? That would be awesome, right? But that's how a stock works, right? And when it gets to that price that you want to get out at, then you sell your stock. And you sell it at the inflated price, $100 a share. You bought it at $1. As it moved up, you sold it at $100 a share. Okay? Now, semantically, when we say in Forex, when we say buy, we just mean we want the market to go up. Okay? Long. Long is buy. Short is sell. Okay? When we say sell, then we want the market to go down, and so we can take our profit. Okay? So as we go through this process, just remember that, because if you've only known stock, or if you have some semblance of understanding of the market, then you may not have known that you can make the same type of profit if the market's going down as when it's going up, which is great news. Why? Because does it matter if there's inflation, or if there's a recession or a depression, or housing bubble 2008, right? If 2011, 2016, 2020, 2021, if any of those things happen in the markets, even for a moment, start to spell disaster, and the Dow is going down, and the NASDAQ and housing and stock prices, everything's going down, you can't do any. And if you're in any of those, then you could potentially lose money, right? Now, you're not able to place any trades if that's the way you're trading, right? Is just if it goes down, you're not able to, you don't want to buy as the market is going down, right? Unless you think it's going to start going up. Okay, so it kind of limits your ability to do some of that, right? Where in day trading, it doesn't matter which direction it's going, we can trade it. So in this example, we want the market to go down. We want this currency pair to go down, okay? And our entry is 1.20696. So let's change that, 1.20696, okay? And we're going to look at those three middle numbers again. and that's 69, right? So 69 minus 5. So we want it to go to our take profit. What is our take profit? 5. So 69 minus 5 is 64. And then bring down that 6, 0, 2.1. Okay. And then we don't want it to go against us the other direction, 10 pips. So 69 plus 10 is 79. 6, 0, 2. Okay? So that means that our take profit is 1.20646. 1.20646. I'll make that line blue. And our stop loss is 1.20796. 1.20796. Almost. And we don't want it to go there, so that's our red line. We want it to go down on the next candles. We want it to go down to that blue line before it goes up to that red line. Okay? So let's go forward. Good. That was just fine. So 10.4 pips, and it only moved about 1.1 pips up. So we'll look at 5 examples. That's 1 example, 2 examples. So we already looked at 2 examples. Let's look for another one. Okay. Those of you guys that are on Zoom, I want one of you guys, just one. So if you all speak, that's okay. But I want somebody, and who knows, maybe one of you guys, only one of you will be brave enough. I want somebody just to unmute right now. Just to unmute and say hello. All right, who's that? All right, Eric, thank you. Hey, Tim, let's get Eric's information and send him a silver coin. We're going to send you a troy ounce silver coin. It is, so these are actually pretty cool. Do you got one handy right there? So I'm going to show you this silver coin, and because I appreciate that, Eric, you stepping up. Let me see if I don't have it right here, I'm not going to go into the safe and grab them, but I think we've got one right here. Oh, you do. Thank you, Mr. Coblin. All right. So these are we have these coins stamped for our organization. You guys might be able to see that right there. This is a troy ounce silver coin. It's got a bear on one side. It's got a bull on the other side. It's real silver, and I'm going to send this out to you. Matter of fact, I'm going to send you a gift box. So there's going to be some stuff in there. I'm going to have my partner reach out to you here in a moment on Zoom in a private chat and get your address so we can send that out to you. Thank you, Eric. So now that I've got you, stay unmuted. Do you feel like you've got a good beat on this setup? All right, here's what I'm going to do. I'm going to click forward. I just want you to tell me when to stop clicking and tell me when you see that trade setup, okay? All right. So I'm going to try to take my time because I don't know what kind of delay we have between you and I. Let me erase those lines. All right. All right. Awesome. Tell me what you see. Yep. Excellent. Major, minor pointed up, green's on top. Okay, so which direction would we trade this? Yes. Solid. All right. So it sounds like you've got some trade experience. You're using the right lingo. That's awesome. I'm glad to have you here. Okay. So let's work on the next step for a moment. And so you can mute for a moment there, Eric. And what I'm going to do is I'm going to replay this chart. The reason why I'm going to replay it is because I want to show you guys that if you're taking this trade, where you would enter, where the appropriate time to enter would be. Now notice when this candle first started, green is not on top yet. Majors are up, minors are down. So we don't have our trade set up yet. We don't have anything that resembles our trade set up yet. So let's fast forward and see when we get that happen. All right, still waiting for that. Okay, let's see. Yeah, green's on top. All 4 lines are pointed up. Now we still have 13 minutes and 43 seconds left on this candle, right? So we're not going to, even though we have all of our parameters right now, we're not going to execute this trade for 13 minutes and 43 seconds. Okay, so if in 13 minutes and 43 seconds all the parameters are there, then as soon as that new candle comes out, we would press the buy button. Okay, now the reason for that is because with these pattern type setups, with these pattern trades, we want it to be as uniform as possible so that it's duplicatable. Anybody can pick. I teach this to 5th graders. Guys, it's that simple. I literally teach this stuff to 5th graders, and they can maintain profitable demo accounts. Obviously, they're not old enough to have live accounts. But it's simple. This stuff's simple. Okay? It's now day trading is simple, but it's not easy because of the back testing, things like that need to be done. And I'm going to show you guys some examples of how we can simplify that as well. But right here we have 13 minutes and 43 seconds. Why are we waiting for the top of the hour? Because most traders around the world, millions of traders, wait for the top of the hour to execute. Now, are we trading like most traders? No. But we're seeing what they're doing in this algorithm. The minor impact is showing us what the retail traders' intentions are. And if their intentions are to remain going up, then we want to know about that. And then the major impact, the institutions, what they're doing. So if they both agree after that occurs, then with a high probability, a very high probability, we're going to get some long movement, some buy movement, right? So it's not enough that an indicator tells you what's happening or what may very well happen. It has to be accurate most of the time, right? Otherwise, you can't trust it. So, the average win percentage in the market for day traders, for retail traders, is 50 to 55%. 50 to 55%. Why? Because a lot of the stuff that they're using for market execution, for determining where they're going to enter a trade, are based on averages. They're even called that, right? ATR, average true range, MACDs, moving averages, right? Or things like trend lines, right? Trend, by the way, if you guys are familiar with trend, it's only good after it's happened, right? So it's just telling you what's already happening. Do you really need a trend line to tell you that the market was moving up? No, you can just look at the candlesticks and see that. You can see that the price is higher right here, and it's been going higher over the last hour, what have you, right? Or if it's a bigger chart, more than that, right? You don't need. So it doesn't really help you because how does it tell you if it's going to continue or if it's going to break through that trend, it's going to start a new trend, right? There's a whole bunch of other things that you have to be able to master in order to use that to get to a 50 and 55% win rate. Guys, I'm going to show you guys data today, empirical data. This is proven, this is back tested. I can show you this empirical data at how our setups will work 70, 80, even 90+% of the time, okay, with risk-reward ratios that are profitable. All right, and I'll explain to you why I keep on emphasizing that here in a moment. Let's get back to Eric's trade here. Okay, 13 minutes and 43 seconds. We're not ready to pull the trigger. So let's get down to the last couple seconds, which means if we're watching this trade, we're probably not going to even be looking for this trade until maybe 5 to 10 minutes before the top of the hour if we're looking at a 60-minute chart. Right? Why? Because we know that we're not going to execute until the top of the hour anyway. So why would we sit around staring at it for no apparent reason if we can't even do anything about it until the end of that candle? And if it's a 60-minute candle, then we just want to look 5, 10 minutes before the top of the hour to see if, maybe across multiple currency pairs to see if the setup is present. And if it is, then we're only waiting around a couple minutes, right? Okay, so with that in mind, at 5 minutes, check this out, at 5 minutes, if this pattern is present on 6 currency pairs that we monitor, automatically an alert will be sent out to our group. And you can get access to this. I'll show you guys how to get access to this in just a moment. You can get access to this stuff, okay? Now check this out. Just today, and the day's not over, it ends at midnight. Just today, let's see, 1, 2 dirty pressure, 3, 4, 5, 6, 7. 7 times already. Let's look at yesterday, a full day. Let's look at yesterday. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 times. 15 times just yesterday. Sometimes they'll happen even up to 20 times. Okay? This happens really, really often. You can see how valuable that would be, right? So when talking about your why, you know, maybe it is time freedom. Maybe it is, you know, the ability to have something that is equal to your job, but you don't have to spend, you know, countless hours doing, right? You just identified the setup. I just taught this, and already we had Eric know the setup, right? I could call on him, and he was ready to go. Okay, so right here, 4 minutes and 58 seconds, right? So right there, we would have gotten an alert. Euro USD, dirty pressure. Awesome. I don't even have to be sitting in front of my computer. The automatic alert went out, and now I know, okay, now I can go and look and verify that that setup is going to stay that way for 5 minutes, right? So let's get down to the last couple seconds here. 3, 2, 1. Okay. And as soon as that candle ends in 40 seconds, 30, 20, 11 seconds, right? As soon as that candle ends in 11 seconds, I'm pressing the buy button. I know the pattern, right? Everything is there. Now I just got to wait for the candle to end. And right there, boom, candle ended. I would have entered that trade right there, or Eric entered the trade, right? And now it is the entry is 1.20538. So our take profit for 5 pips is going to be 1.20588. Right there, yes, got it. Okay, 1.20588, right? 5 pips, and then a 10 pip stop loss, 1.20438. All right, 1.20438. Make that line red. All right, Eric, you already won the coin. Let's see how you did. Let's see if you win this trade. All right, let's fast forward that so we don't have to watch paint dry. Okay, you can see as it goes down, it left that wick, right? When it went back up, it left that shadow, those thin little sticks on top and bottom. Here we go. Yes. All right. There you go. Nice call on that, Eric. Yes. All right. Awesome. Okay. Let's look for another setup here. So what was that? That was 3. Okay. All right. Who else? Someone other than Eric that's on Zoom right now. Unmute, and you're up to bat to call the next one. Come on. Any takers? Don't be shy. Unmute. Going once. Going twice. All right, you guys got away with it this time. You're a brave man, Eric. I appreciate you doing that. It looks like we didn't have any other takers. All right, so let's see how serious you guys are. I mean, this is calling out a trade on a live webinar is nothing compared to trading in the live market. So you know, hopefully you guys got the backbone for that. All right, here we go. So right now green is on top, so we want to wait for green to pop on bottom of red. And then we'll look for our next sell setup. All right, if before we get there, if you want to unmute and say stop clicking or say that you'll take the reins here, let me know. All right, who is this? Awesome, Amy. All right, I appreciate that. Look at that, Eric, you got the crew. Whatever you're doing over there, you're doing it right. All right, Amy, I appreciate that. Okay, you ready? Do you feel like you got a good beat on this? Okay. All right, here's what you're going to do. You're going to tell me when to stop clicking. Real quick, I'm going to just test the delay just so I know how fast to click. Tell me the moment you see me scribbling on my screen, okay? All right, good. Very minimal delay. Okay. All right. So let me know when to stop and then explain what you see and which direction we should trade, okay? All right, here we go. Okay. All right. Nice. Yep. And yeah, so we don't even need them, we don't even need them to cross, right? We just need them to be pointing down when green's on bottom. So yes, that is a setup. Which direction are we trading this? Yes, awesome. Okay. Good job. Thank you. And what was your name? Amy. All right. Thank you, Amy. I appreciate that. Okay. So 1.20592 would be Amy's entry. 1.20542, if we were using the parameters that we're using today, would be Amy's take profit, right? So let me show you guys what that would look like in here. Oh, wow. Look at that. Okay, let's close that. Okay. So let's say that we were going to take a sell trade. So we would press the sell button right there. Okay. And then we would, so our entry for this example right here, which is going to be different than what we're looking at in our charting software, but because this is live and what we're looking at is historical. So our entry right here is 1.18096. And if we wanted to go 5 pips down from there, so that we'd go 1.18056. So right here under take profit, we would go 1.18056. And then our stop loss, so you can see right there, it'll say, oh, that's 4. 9 is going to be 46. Whoops. I can't count today. 46. So we want it to go down to that line right there. We don't want it to go up, but if it does, we don't want it to go any further than 10 pips above us. So 1.18196 will be our stop loss. Right here is stop loss. 1.18196. Okay? We don't want it to go there. We don't do anything there because we already set that. Now we set that one, and there we go. We don't want it to go to that line before it goes to that line. So that's what it would look like if we were executing here in MetaTrader 4. Okay, now I just drew these lines for Amy, and 1.20592 is our entry, so 692, 1.20692 would be our stop loss. So we don't want it to go up to that red line before it comes down to the green, or rather to the blue line. So we want it to go down to the blue line. Let's see what happens. There we go, money. Boom, nice job, Amy. So that went 14.7 and only about 4.2 up. So it did go up, right? Maybe it went down first, but if it didn't, it went up. You know, maybe we got some drawdown, but it would not have cost us anything because it didn't hit our stop loss. And then it would have continued and went almost 3 times the amount we were looking to take profit. And let's look for one more example. Do I have anyone else? Someone else? Come on. Speak up, ladies and gentlemen. One other person. Okay, I'm going to start clicking forward. If you feel brave enough, go ahead and speak up and let me know you want to take part in your own success. Or you can be shy. That's all right. Okay. Green's on bottom right now, so we're waiting for it to pop on top. Okay, so green's on top, but when green's on top, which way do we want these lines pointed? Up, and they're not, so no setup. Now, because green just popped on top, even if these do point up next, it doesn't matter because we want to see them already pointed up when the intersection happens. So let's continue. Okay, Green is now on bottom. Majors are down, minors are up, so they're not both pointing in the same direction. No cigar, right? Now we got to wait for it to reset, right? We got to wait for green to pop on top of red now. Who's that? Somebody want to step up to the plate? Somebody unmuted? All right, I'm going to go forward. Yeah. All right, who's speaking? All right, Lax, are you ready? Okay, tell me when to stop clicking. Yep. Yep. So green is on top. And where do we want these pointed when green is on top? Yep. Up. Good. Awesome. So we have our setup right here, right? Awesome. Okay. So our entry would be right there. And that's 1.20226. So we'd go to 1.20276. 1.20276. And our stop loss would be 1.20126. So right about 26 right there. Okay, let's go forward and see how you did, Lax. Yes, money right there. 12.1 pips up, so more than double we were looking for here, and only about 2.7 down. Good. So we knocked down 5. Thank you, Lax. Appreciate that. Cobes, let's send Lax a coin as well. So let's get her information, and then we'll throw something in for Amy with what was his name, Eric's information, or when we send Eric's out, because it sounds like Amy and Eric are in the same place. So we'll send something extra for Amy as well. So we'll send something for Lax. Thank you guys for participating. I appreciate that. Okay. So let's look at this really quickly in theory. Now, let's say that we took these 5 trades, okay? Now, when we fund corporate accounts, we max funded $100,000, okay? So let's say you're trading a $100,000 corporate account and keeping 80% of the profit. Now, we're not going to do the 80%, but in our math here, but I just want to show you an example, okay? Now, let's say that we were trading this trade and we took 5 trades. We took these 5 trades, right? Now, each of those trades, let's just say, we'll be conservative. We'll just say a lot size of 5. Now, when we talk about lots or volume, a 5.0 lot, and I'll show you over here. So right here we had a 1.0 lot, right? And a 1.0 lot is $10 every time the market moves for or against you by 1 pip. So if this moves down to this 5 pip take profit, we make $50 because 1.0 is $10 per pip. $10 per pip 5 times is $50, right? Now, if we were doing a lot size of 5.0, then it would be $50 per pip. So $50 per pip. Okay, and that's conservative if we had a $100,000 account, only a 5 lot. Okay, so $50 per pip 5 times, right? So that would be $250. Okay, now because we took a 5 pip take profit, right? So each trade would be worth $250. Okay, and we took 5 of those trades, right? So that's what? 1,250, if my math is correct. 255, 1,250. Yep, $1,250 for those 5 trades. Okay. Now let's say we just had a $10,000 account. Okay. And we're at a lot size of 1.0. So 1.0 is $10 per pip, right? We just talked about that. For 5 pips would be $50. We'd make $50 per trade. And we took 5 trades, right? So that'd be $250. $250 for 5 trades. Now, I don't have to ask you if you can do 5 trades in a day, because I just showed you, even on a soft day like today, we had 7. Yesterday, we had 15 of those setups occur. So I know that you can take at least 5 of those a day, right? Now, even with these really conservative numbers, ask yourself, what could $250 do to achieve your why? Would that work better than some of the things that you've done in the past? Would it be valuable? Maybe the answer is no. And that's okay if the answer is no, right? But I would venture that for most of you the answer is yes. That if you could do $250, if that was where you could start, right, and start growing from there, because as your account grows, that same 5 pips just becomes worth more and more and more dollars. It's not like you have to do extra work. It's not like you have to get extra movement in the market. You can just always take that same trade 5 times, right, and make, maybe to start 250, but then your account grows by 250. So then you're able to make more out of each of those trades, and so on and so forth, right? That's how it works. It's compounding, and it is incredible the way compounding works. Okay, so ask yourself, is that valuable, right? What are the things we wanted you to be able to evaluate? Is it valuable, right? And obviously I don't want you just to kind of take even what we're doing right here. I want you to still try it. And I'm going to show you in just a moment how you can try this out for yourself, right? To see if you have what it takes to trade our corporate funds, so that we have an opportunity to vet you, you have an opportunity to vet us, and we can see if the next step is good for you, right? Okay. So let's go back to, I want to show you guys something real quick, because I want to make sure that we're on the same page with something. So the next one I'm going to show you is the hiccup pattern. But I want to show you this. I want to go over this really quickly. Okay. And this is, I try to include this in most of my sessions, because it's important for you guys to understand, especially for those of you guys that are unaware. Okay. If you're new to trading, this is important for you to understand, because I'll tell you right now, this is how people will take advantage of you. This is how people will take advantage of you. But if you know these things, then you know the right answers, the questions to ask them, so that you can see through their garbage, including us, because it's just math. So I'm going to break this down for you. If you have questions, chat them in. I want you to engage in this, right? This is cool. This is going to blow your mind. More movement, or more pips in this case, and or higher win percentage doesn't always equal more money. Okay? So some of you may have been of the persuasion that if you get, a bigger move in the market, right? You start here and you take profit here, you're going to make a whole bunch of money. Right? So what is worth more? 100 pips? Right? If the market moved 100 pips or 10 pips. Okay? So let's look at 100 pips. Let's say your account balance was $10,000 and your win percentage is 70%. That means 7 out of 10 trades you win. Your risk reward is 1-to-1. That means 7 out of 10 times you win 100, and 3 out of 10 times you lose 100. It's a 1-to-1 risk to reward ratio. That's awesome. By the way, a 70% win rate with a 1-to-1 risk to reward ratio at an increase of 2% a day. If you just traded to 2% a day, a 2% increase to your account every day, you could double an account every month and a half. So that's, even if you started with a $2,000 account, that would be $4,000 in a month and a half, then $8,000, then $16,000, $32,000, so on and so forth. Right? That's why more millionaires are created in day trading in a year than any other industry, for the 10%, less than 10% of individuals that can do it right. For everyone else, they just lose money. Okay, so there's your risk to reward. Your risk percentage, we're risking 2%. What's 2% of $10,000? $200. So we're risking that. Our lot size is 0.2, which is $2 per pip, because $2 100 times, right? Follow with me here. $2 100 times equals $200, which is 2% of 10,000. Okay? So that's why our lot size would be that way. And that we figure that stuff out by back testing. Okay? Now, we take 10 trades. We win 7 of them, right? For $2 per pip. So 100 pips, that's $200 per trade. $200 7 times is $1,400. Okay? And then we lose 3 of them. So we lose $600, right? Because $2 100 times, right, is $200 times 3 is $600. So $600. Our profit is $800 after loss, right? We win $1,400, we lose $600, we make $800. Okay? That's for 100 pips. Now let's look at 10 pips. Same account balance, right? $10,000. Same win percentage, 70%. Risk to reward, same risk to reward, 1-to-1. But this one is 10 and 10, that one's 100 and 100. Okay? Our risk percentage is the same, 2%. Okay? Our lot size is 2.0. Why? Because it's $20 per pip. $20, 10 times, which is our stop loss, that's what we're risking, is $200. And $200 is 2% of 10,000. Okay? So all of that is the same, except this number is bigger than this number. Right? And I'll show you why here in a moment. Okay, we take 10 trades. 7 win, just like before, 1,400. 3 lose, 600. Profit, 800. So we make the exact same in 10 pips as we do in 100 pips. Okay? Now here's the advantage to taking a trade like a 10 pip trade versus a 100 pip trade. A 100 pip trade you may not be able to get every day. Where a 10 pip trade you may be able to get multiple times a day. Okay? So if we took the same amount of trades, 7 here and 7 here and 3 and 3, if we compounded each of those at 2%, then every time I had a winner, I would risk 2%, right? And every time I had a winner, I would risk 2%. But let's say that I could only take this trade once a day. Or, I mean, the 100 pips, that might be tough. But let's just say once a day. So it would take me 10 days to make $800. Let's say I could take this trade twice a day. Then it would take me half the time, 5 days. Right? Because I could take this one more often, it's more valuable. So a scalp method will always outperform a long-term method when it's tit for tat. Okay? So the amount of movement you get in the market only has bearing on how much you make based on these other parameters. Okay? In this case, in this particular case, it would be your risk to reward. Your risk to reward 1-to-1, right? And then your risk percentage. That's what determines what your trades are going to be worth. So right here, this risk percentage, it doesn't matter if this was 7.5 and this was, 35. It doesn't matter because regardless, you're only going to risk 2% on each of these trades. And if they're both a 1-to-1 risk to reward, then you're going to risk 2% to make 2%. It doesn't matter if it's 2% in 7.5 pips or 35 pips. Right? So that doesn't matter. So why try to, over stress yourself about those things? And if somebody's trying to tell you, oh, we get all this movement in the market, there could be situations where they're actually losing money if they don't do this right, which is very common, by the way. All right, let's move on. All right, so 90% win rate versus a 70% win rate, okay? Which one do you think would be worth more? So chat that in if you have a guess on that, okay? So 90%, same account balance, 10,000. Win percentage, 90%. Here we're going to use a 5-to-1. So that means that we have a 50 pip stop loss and a 10 pip take profit, which, by the way, does work profitably with a 90% or better. Okay. Risk percentage, 2%, just like before. So we're going to risk $200 in 50 pips. So our lot size is $4 per pip, a 0.4 lot size. Why? Because $4, 50 times equals $200, and $200 is 2% of 10,000. Okay? So we take 10 trades, and we win 9 of them. $4 for 10 pips is $40, right? $4 for our 10 pip take profit is $40. $40 9 times equals 360 bucks, right? So we have $360 profit and 1 loser for $200 because we're risking $200, but we only had 1 loser. So we make 160 bucks. Now we have a 70% win rate. Account balance 10,000. Win percentage 70%, not 90, 20% less. We win 20% less on this trade. Our risk to reward is 1-to-1. 10 pip stop loss, 10 pip take profit. Our risk is 2%. Our lot size is 2.0 because $20 10 times is $200, and $200 is 2% of 10,000. Okay? So we take 10 trades, 7 of them win, 1,400, 3 lose for 600. Our profit is $800. 70% win rate, $800. 90% win rate with this scenario, $160. Which would you rather have? Right? Would you rather have a 90% win rate in this scenario or a 70% win rate in this scenario? A 70% win rate, of course. Right? Why wouldn't you want to pick the one that makes more profit? Now, what makes the difference there? The risk to reward. If I had a 1-to-1 risk to reward ratio here and here, then the 90% would be worth more than the 70%. This one would be worth more if it was a 1-to-1, but it's a 5-to-1. So our risk to reward causes for us to make less profit. Where here, it's a tighter risk to reward, which causes for us to make more profit. Okay, so it depends. It depends. Win percentage doesn't necessarily mean that you're making profit in the market. Okay, it doesn't mean that you're winning. We could have a situation. I'm just going to give you a quick example. Let's say you win 99%. Let's say somebody says, we win 99% of our trades. You should come and trade with us. You should come and use our program. We win 99% of our trades, right? This is what you ask. Okay, what's your risk to reward? Okay, oh, we don't use stop loss, or we just let it go 100 pips, whatever, right? If they know what they're talking about, then they'll tell you. And if they tell you, right, and it does work out profitably, then you can go back and check it because now you've got the parameters, right? You know what the setup looks like. You know what the stop loss and take profit is, and it's supposed to win 99% of the time. So you can go back historically and see if it actually does, right? And you can see if they're telling the truth or not, right? Just like you can with us. And I want to give you the ability to do that, and we're going to get to that here in just a moment. Okay, so they win 99% of their trades, right? Because they're trying to sell you something usually. And believe me, I'm trying to sell you something too. But I can show you mathematically and scientifically why we're the best. I can prove it. I can show you mathematically and scientifically so that you can see. And not because I said it, but because you'll be able to see for yourself. Right? Okay, so they win 99 and they take 10 trades. So 9.9 of those trades win, right? Obviously, this would work better if we had 100 trades because it would be 99 of those trades. 9.9 times, let's just say 10 pips. They took 10 pips on each of those, which would be a profit of 99. Right? So profit of 99 pips. And they lose 1 or 0.1, right? But they're using a 10-to-1 risk to reward ratio. So their stop loss is 100 pips. 1 loser, 100. They win 99% of their trades, but they still lose money, right? Because your loss is greater than your gain. So you lose. This is simple math. This is not day trading specific. This is just math. It's risk to reward. If your risk to reward is, let's just say, 2-to-1, for example, then you cannot have less than a 70% win percentage. You have to have 70% or better, right? If your risk to reward is, 5-to-1, like this example right here, then you have to have a 90% or better win percentage for that to work out profitably. Okay, it's all just math. It's not because I said so. It's just the way math works out, right? Okay, so now I want to tell you guys, I want to discuss with you guys for a moment how you get to a point where you can, obviously the way you figure that out is by backtesting. I forgot I was supposed to drop that on you guys. Anyway, how you can get to a point where you can day trade our corporate funds, okay? Now, we have a process that's called the Trader LITE process, okay? And what that allows for you to do is vet us, right? All the things that we talk about, we show you trade setups, you practice them, you see, can you do it? Is it valuable? Does it meet a personal need, right? Is what we're offering good for you? And we get to be able to see, we work with you one-on-one, we get to be able to see with you if you're a good fit for us, right? If you show up to appointments, if you're teachable, if you attempt to do the homework, you know, if you're not able to make an appointment, you communicate with us, right? That's all we're looking for is good students. And then obviously you want to be able to see if we're good for you as well, right? So what does that look like? The Trader LITE program is normally $800 and some, which I'll be honest, we rarely ever charge. We always have different promotions. Matter of fact, we just finished a promotion that was free. That's why this site right here is daytradesmart.com/free, because last week it was free. Right now it's $10. $10, and we'll donate 100% of that to charity. What are you going to get for $10? You're going to get our proprietary indicators. You're going to be able to have access to our proprietary indicators for 30 days. You're going to have on-demand training videos you can watch at your leisure. Weekly continued education webinars, live webinars, daily trading webinars where you can take trades. We do webinars where coaches come on, they take trades with our students. You'll be able to participate in that. Trader chat for mobile and desktop where you can communicate with other traders, right? Real-time alerts, those alerts that we talked about, you're going to get those, right? And you're going to have all kinds of resources you can learn all those patterns as well. Flashcards and videos and all kinds of stuff, right? And you're going to get 2 one-on-one sessions with a professional day trader where they will show you winning trade setups and then have you practice them and show you how day trading is done, okay? So we're not even making a profit on this. We are giving all of this to Feeding America. That's the name of our charity partner this month, Feeding America. We are going to give everyone that signs up for Trader LITE through our organization the $10 that they spend. So not just you guys that are on this webinar right now, but all of our other marketing campaigns that are out right now. When they sign up for the Trader LITE program, that $10 that they spend is going to go to Feeding America. So get on board with this. Try us out. See if we're a good fit for you. See if this is something that you can do, if it's valuable, right? If it meets a personal need, whatever that need may be. Right, and I know we only showed one setup, and I'm going to go back here in a moment, but I did want to give this information to you guys before we ran out of time, because if I run out of time showing you a trade setup, good, then you'll get on the Trader LITE trial, and then I'll pair you with a coach, and they can go over that setup with you, right? So if you miss what, if we go back right now, we're not able to finish up some of these trade setups, then you still have the ability to sign up and get on board with what we're doing here, right? And for $10, you can't beat that, guys. $10, $10. Skip your coffee tomorrow, right? I stopped at Starbucks this morning, as a matter of fact. It was like $9 for a venti, right? I got the extra shot and all that stuff, but spare that. Do something that could very well get you to your why. You're here because you're interested in day trading, and you're in the right place. We are the best in the business, so much so that we put our money where our mouth is. We know that when people go through our training, we can get them to a point where we can trust to put money into a brokerage account for them to trade on, and they keep 80% of the profit, right? So that's what we're proposing here. Go to daytradesmart.com/free. It's not free anymore, but $10, and you get onto the program. We'll get you all set up. We'll get you logged in, and we'll be on our way. We'll be able to vet each other. After that point, we go into talking about moving on to the next step. Okay. Now, I want to be very clear. We're a legitimate organization. So the next steps after the Trader LITE, after you've qualified and we accept you into our trading university, after that, the enrollment is anywhere from $8,000 to $23,000. So now you understand, if you're just curious, that's not up your alley. If you are serious about day trading, that's what it costs to learn, right? If you're serious about becoming a doctor or a lawyer or going to school for any kind of degree, it's going to cost you way more than that. And you won't get job placement. We're here. We're going to train you. We're going to put money into an account for you, and you're going to be on your way. So the juice is definitely worth the squeeze, and you can see that really quickly. And there are millions of ways that we have to help people out with financing, things like that, but we're not even at that point yet. We don't want to talk about that next step, right, what that looks like, until we've had an opportunity to vet you and you've had an opportunity to vet us. But it would not be fair if we got you into something like this without telling you what the monetary cost is for the next step, right? So we don't want to waste your time, and we don't want our time wasted. So generally, when we throw that out there, people will automatically disqualify themselves because their why is not important enough for them. They would rather spend that money on something else. You know, maybe get a new car that's going to break down before you have enough money to get another one, right? Maybe, you know, go on a vacation even though you can't afford it, instead of doing something right now, right, that can create multiple vacations in the future, that can get you a new car every year if you like, that can change your financial trajectory, not just for you, but for your children and for their children. You can create generational wealth. That's not an exaggeration. We've been doing this for 2 decades, right? These indicators have been around for 2 decades. We've actually been able to see some of that happen to this point, right? So make the decision to give it a shot, try it out, right? See if it's a good fit. Maybe it's not. Maybe you can't do it, and or it's not valuable, and or it doesn't meet a personal need. If any one of those things is no for you, then it's a no. And we're not going to pressure that. That's fine. If it's a no, then there's no value in it for you. And if there's no value in it for you, then we know that you're not going to be successful. So why would we want you to go through the program and then give you money to trade on if we know that you're not going to be successful with it? Same thing for us. If we see that you're not a good student, you don't show up to appointments, or you're not teachable, we'll tell you that. We'll let you know. Right? And the number one thing that we tell individuals that are already existing traders, so if you are an existing trader right now, the only thing we ask is if at some point, and we may not, but if at some point we ask you to forget everything you know about day trading and allow for us to retrain you, you've got to be open to that. And if you're not, then this is not the program for you. We don't want your $10. It's okay. It's not like we have anything against you, but it's generally those things, the things that you're not willing to let go of, that are causing for you to lose. And that's why you're looking into things like this and other things, is because you have not been able to be a successful day trader. We've talked to people that have been trying it for, some of them over a decade, and they've never been able to be successful long term. Never been able to get to a point where they're trading for a living. Right? We want our traders within 12 to 18 months to get to that point, right? Where you've got a return on investment, supplement income, replace income, build wealth. 12 to 18 months, we want to see you be at those points, right? All right, guys, let's go back to one of these other setups, and I want to show you guys something really cool, and I got about 20 minutes to show you, so I'm going to hit it. All right, so this is a hiccup pattern, and I'm not going to go, I don't even know why I did that, because I'm not even going to go through the slide. Okay. So let's just get rid of all this. We're going to use a 60-minute Euro USD chart again and go back, and I want to show you something. So for those of you guys that have traded, you guys are going to be able to follow right along with what I'm about to show you. For those of you guys that haven't, I'll try to take it one piece at a time. But I do have videos on this, so if you go to our YouTube channel, which is daytradesmart.com/the proving ground. No, that's not it. YouTube.com/the proving ground. You'll see that we've got these, what is day trading for beginners. Watch that stuff, guys. It's solid. A lot of stuff that we covered here today, a lot of other setups you'll find in those videos. Feel free to join us for the sweep, so subscribe to our channel. and join us for the sweep on Fridays. So tomorrow at 5 o'clock Eastern, we do the sweep every Friday. And those are different, right? The session we're doing today, this is just going to be repetitious, right? We're going to do the same one every Thursday, but these are always different. So the sweep, join us for those. Okay. So I want to show you guys something. So here's a hiccup pattern. And a hiccup pattern starts with what we call a hiccup. And a hiccup is just basically the lines within a pair disagreeing. So green is up, red is down, so they just disagree. Okay. Now, when that occurs, you want that to happen below the red or above the blue. Okay. And then so that's the first. The second is we want minors to be crossing and touching the threshold or beyond. So when they're below the red, we want minors to be crossing up and majors hiccuping. So they're not crossed or touching at the end, and they disagree. Red's down, green's up. And then the third is we want this green pressure line to be below red. It doesn't matter if it just crossed. We just want it to already be there. And then a green candle. Now, right here, this is what we call an illogical setup because it doesn't really look like the indicators are agreeing in one direction or another, right? But right here, we would look for a sell trade. And so this is telling us to go short, to sell, okay? And then after we sell, if all four of these lines are pointed down, okay, and I'm not misspeaking here, if all four of these lines are pointed down, after the fake out, which is what that is, then we would look for a buy trade, a long trade. You heard me right. These lines would be pointing down, and we'd be looking for a long. Not just because they're pointed down, but because they were pointed down after a fake out, and they're oversold. Okay? So right here, we're going to take a short or a sell trade. Okay, good. That moved 16.5. That's plenty. These are both not pointed down, so we'll skip that one. And then if they were pointed down, then we would take a buy, a long trade, and then after that, normally these would then be pointed up. And then we'd take another buy trade. So on the first candle, we would sell. On the second candle, we would buy. On the third candle, we would buy. Okay, so it's a 3-trade setup if the follow-up parameters are present. Okay. All right, so let's go look for another example. Okay, so right here, green is down, red is up, and they're above this blue line. Majors are above the blue line. Minors are crossed and touching the threshold or beyond. Green pressure is on top this time, right? So back here, we had green up, red down, minors crossed and touching the red, green on bottom in pressure. Right here, we have green down, red up, minors crossed and touching the threshold of the blue, and green on top. And then back here, we wanted a green candle, and then we sold. And here, we want a red candle, and we're going to look for a long or a buy trade. Okay? Now, check this out, guys. I want to show you guys something. For those of you guys that are aware, and maybe some of you guys have tried trading with some of this stuff. Okay? I'm going to show you real quick. All right. So let's go to clean chart. Okay. Whoa, what happened? Oh no, I lost my place. Oh. Right there, okay. Where was I? Oh, here we go. Okay. It's probably because I don't have enough candles. Yeah. Let me see. What is the date here? Okay. Let me go back here. Let's go to this one. Okay. Why? course, because we're live, right? That's why it's happening. Okay, I didn't expect to do this, so just kind of running an audible on this one. 11. Okay, all right. Let's get rid of these other charts just so we don't have all this other stuff going on. Okay, now let's look for that setup. Okay, all right, check this out. Finally, right? Enough build up. Okay. So what would we call this? And if I just said uptrend or downtrend and you knew nothing about the market, your brain would put together that downtrend means that the market's moving down, and uptrend means the market's moving up. So if I asked you, is this an uptrend or a downtrend, even if you knew nothing, you would know that this is a downtrend, right? And that would be a safe guess, and you would be right. Now, a lot of times what we'll do as traders, well, not necessarily us, but what traders will do is draw trend lines, right? And if for those of you guys that have done this before, you know what I'm talking about. So you draw a trend line, trying to find a good starting point. I want to catch all that action. Yeah, that's better. Okay. And the basic concept of a trend line is that if it goes, you know, to the top or near the top, it's going to come down. So it kind of moves like this, right? And the market steadily moves down. Okay. And then support and resistance. So we've got resistance right here, where the market's gone up and rejected price, and support right here, where the market's gone down and pushed price back up. Okay. Now look at this. For those of you guys that are, you guys can already see what's happening here. So what's common with retail traders is they see the trend and we're at the top of the trend, right? So they say, okay, we're going to start getting ready to sell, right? In addition to that, we have a resistance level right here. And as this candle pulled back, that created a candlestick pattern, which is saying we should be getting some sell soon, right? And the most common, what they call H1 reversal is, so H1 is 1 hour reversal, is price action. And price action is just when you have a low, like this one right here, this low is lower than the previous low. So that one ended right there and that one ended there. So that one's lower. And a high that's lower than the previous high. Okay? So that right there is your trigger. Well, not yours if you guys are doing it right. That would be the trigger, right? To sell. Okay? And we're saying buy. So why are we saying buy? Because the majors are getting the miners to sell. Right? Who do you think invented trend and support and resistance and channeling and candlestick patterns? The same institutions that are taking you to the cleaners. Why? So they know exactly where to take advantage of you. So it's simple. This means they're neither buying nor selling. They're just releasing trades. They're just releasing trades, and as they release trades, it creates that hiccup. And then it pulls back, and then the miners say, oh, it's time to sell. So then the miners sell. That creates a candlestick pattern and a price action. And then more miners start to sell. And this is a zero-sum game. And in a zero-sum game, the winners get paid by the losers. In order to buy, somebody has to be selling. In order to sell, somebody has to be buying. Okay? We can see this happening in our algorithm. I'm telling you, you've never seen anything like this. I've looked. If you have, you should definitely show me. I'd be interested to see. Because I've never seen ever, and I've been doing this for a long time, I've never seen indicators work as accurately as these. So right here, as the rest, millions of traders are trying to short or sell, we're saying it's time to go up. It's time to buy because the majors are saying we're tricking the minors. So then we buy. We go up, right? So there we go. That went up 11.7 pips. And then at that point, we know that 60 to 65% of the time, the market's still going to go up a little bit. So generally we'll position to short, to sell. But because these lines are pointed up, that's telling us to get ready to sell. Okay? And then after that, so that went up a little bit, and then down a little bit. And then after that, normally both of these lines are pointed down, and so then we sell again. Now right there, they're not yet. That's a bootleg. That's another pattern, but we won't talk about that one this week. Now they're pointed down, and then we sell again. Okay? So one other one I want to show you real quick. So what time is it? Yeah, we got time. Is a head fake. And this is another fake out pattern. Okay? And it's an illogical setup. This time, the first element is minors are crossed and entering the channel. Majors are also crossed, but they're hung back. They're hanging back, so there's separation between major and minor. And just like the hiccup pattern, green is on bottom in pressure, and there's a green candle. So those two are the same, right? So 1, 2, 3, 4 parameters. Okay? And just like the hiccup pattern, we want this to sell. We want this to short. Okay? And then after it shorts, we want these lines to point down, and if they are pointed down, then we're going to buy. And then after that, the lines are going to be pointed up, and then we're going to buy again. So check this out. Sell, and there's a sell, 2.4 pips, and then that went 16.7. So good, we had gotten a reasonable sell. Now these lines are pointed down, right? After a fake out, if they're pointed down, that means that the market is vastly oversold. That means that if there's too many people selling, not enough people buying, then there's nowhere else to go. There might be a little bit left, but it's more likely we're going to go up with a high likelihood of certainty, right? So right here, we buy. This is telling us to go long, to buy. It seems illogical. It seems counterintuitive because those lines are pointed down. But we understand how the market works. We understand how our indicators work, and we can teach you this stuff. This is a pattern that we actually send out alerts for. So right here, we would take a buy, a long trade, a buy trade. There we go. Moved down a little bit and moved up, right? And then these would then be pointed up. So then we'd take another buy. And finally, we get an example of all three. Boom. Okay, let's see if we can find another one. Here we go. Another one right here. Minors crossed, entering the channel. Majors hung back. Green on bottom. Green candle. So we sell. First trade is sell. Good. Both lines are pointed down. So now we buy. So it's backwards, right? These are pointed up, but these small nuances are telling us, the indicators are telling us to sell. So we sell. And now they're pointed down, and because they're pointed down after the fake out, the indicators are telling us to buy. That's what they're telling us to do because we know how to read them. We buy. Good. That moved up 39 pips. And now they're both pointed up. So we buy again, and it's actually dirty pressure as well. Green just popped on top. So that's kind of a bonus, right? So we buy again. Boom. I'm telling you guys, this is fire. I want you guys to be able to experience this for yourself. I want for you guys to be able to vet this yourself, not just take my word for it, but actually be able to put this into practice, right? And perhaps some of you guys that are watching on Facebook or YouTube or here on Zoom, maybe you guys have tried this out or signed up for our Trader LITE program before, and maybe you guys didn't show up to the appointments. Maybe you guys are in a better place now where you can show up to the appointments and you can be a good student. Then awesome. You're going to have to pay $10 this time though, right? Maybe last time you got in for free, maybe before you paid $95. You know, we've had it even up to $200. It's been a long time since we've actually charged the full $800. But right now, $10. Do not delay. Jump on this. That $10 is going to feed some children, right? But it's also going to give you an opportunity to see if this is a good fit for you, to see if it's something that is going to help you reach your why. why you're looking at this, why you've looked at other things, not just day trading. Why, right? Because you want to be able to retire comfortably. You want to be able to quit your job. You want to be able to have a better lifestyle. You want to be able to send your kids to better schools, right? You want to drive a nicer car, live in a bigger house, whatever it might be. Whatever your why is, let's see if we can meet it. And maybe the answer is no, but let's give it a shot. The only way we're going to know is if we try. All right, guys, unless you guys have any questions, I am going to call it a night for tonight. Let's see right here. Link, please, for tomorrow. So for tomorrow, I assume you're talking about the sweep, and so that's going to be YouTube, youtube.com/the proving ground. Okay, I just messaged that. I think that was Laxmi that asked for that. So I just sent you the link to that. If anyone has any other questions, I'll go to hang out for another 5 minutes. And we're all set for the night. So if you guys don't have questions, you're free to go. Otherwise, feel free to ask those questions and we'll get them answered. And we'll hopefully be able to work with you. So go to that site, sign up for Trader LITE program, and let's get you scheduled with the one-on-one coach, and let's get you going, see if it's a good fit. Thank you guys for joining us. We appreciate it. And if you guys have other people that are interested in day trading, just know that we do these every Thursday at 8 p.m. Eastern. So definitely send people. Eric, you're very welcome. Awesome. Glad to hear. Hopefully we got your information. If we did not get your information, Eric, please email us. And same thing for Lax. Email us info@daytradesmart.com so we can get your mailing address and send you guys those boxes, those gift boxes. My pleasure, Laxmi. Thank you for joining us, and we will look forward to working with you guys. I'm just going to hang out here for another couple minutes, guys, for about 5 more minutes. If you guys have questions, feel free to chat those in, and I'll just hang out and wait for those. Mark, yes, they are absolutely attainable. We schedule them around your schedule. So the courses, so the one-on-one sessions would be based on your availability. So yes, and that's why we focus a lot on the Forex market, because it's open 24 hours a day, 5 days a week. And so that gives you plenty of time to be able to practice. And actually, when you're ready to, go live, most people still have full-time jobs. And so while they're making that transition from their full-time job to trading full-time, they will, trade during times that they're available, right? Which is kind of what we talked about earlier with setting the, your available time, what time works best for you is the best time to trade. So yes, to answer your question, yes, the courses are attainable if you have a full-time job. And for the one-on-one sessions, and all of our content that we do, webinar, things like that, they're all recorded. And so if you don't get to catch a live webinar, which they happen at all hours of the day and night, if you don't get to catch a live webinar, we upload the recordings, and you can watch them at a later time. Can you use this trading options? Steve, you can. I'll tell you right now, I don't recommend options, mainly because the broker can trade against you. So the brokers, prop desks, trading firms, market makers, with options and ETFs, they can trade, they can see your positions, and they can deliberately trade against you, and it is completely legal. It is not illegal. In Europe, actually, they've made some serious laws against options and ETFs because brokers were way out of hand like they are here in the States. So, that's my recommendation. I've met a lot of broker dealers in international traders expos, and none of them, a lot of these broker dealers that I meet that trade, don't trade options. Like, what? They don't trade options. They trade Forex, they trade futures, They trade cryptos, you know, metals, things like that, oil, but they don't trade. A lot of them don't trade options, and it's because, for one, because they work for an options broker, they can't use their options company to trade options, which means they'd have to go to another options broker and trade options with a different broker, but they're aware that the broker can trade against them, so they don't do it. But to answer your question, yes, you can use it for options, but that's just my 2 cents. You know, if you've got, you know, something that works, I'm not trying to dog you, I'm not trying to say that it's not working for you, but personally, I don't recommend nor trade options or ETFs. My pleasure. My pleasure. Thanks, Mark. Thanks for attending. Okay, guys, with that, I'm going to go ahead and sign off. If you guys have questions beyond what you were able to ask right now, of course, feel free to email us. Again, that email address is info@daytradesmart.com. And I'll go ahead and go to that slide. I'll leave it on that slide so that you guys have that information in front of you in case you need it. There you go. So if you guys have any additional questions, here's our email. My pleasure, Steve. Thank you for joining us. I appreciate the question. All right, you guys have a good day, and we'll look forward to working with you. Thanks.